Gold just fell 6.5% in the first half of this year. That is a losing streak for precious metals you haven't seen since before the great inflation scare. Wednesday, July 1st, 2026. Like and subscribe for daily market updates. Today's agenda: Market Snapshot, the war that changed everything. Chips won, software lost. The gold paradox explained. Crypto had its worst half, second half outlook. Up next, the war that changed everything. Let's look at where things stand right now. The Nasdaq Composite closed near $23,242 on January 1st and climbed to roughly $34,000 by June 30th, a gain of nearly 13% for the half. That is strong performance, but remember that this rally happened while interest rates stayed high. A market can rise with expensive borrowing costs if earnings are good enough, which has been true here. The Dow Jones finished up about 9% at an all-time record, near $52,319. The S&P 500 gained 8.5% to reach 5,000-something levels on the index scale. Brent crude oil jumped from $61 a barrel in January to well over $80 by June, reflecting that global political tension eased somewhat. Gold is where it gets interesting for you. It hit an all-time high near $5,600 back in January, but has since dropped to around $4,000 per ounce. That is down roughly 25% from its peak. Bitcoin lost about 31% of its value, sliding from the high 80s and thousands down towards 60,000. What does this mean for your portfolio? If you own broad indexes like the S&P 500 or Nasdaq, you have participated in a solid rally despite higher rates. But if you hold gold or crypto as hedges against inflation, those assets are currently negative territory. That brings us to Chips won, software lost. You cannot grasp this market half without understanding how the conflict with Iran fundamentally altered global capital flows. Ignited in February and de-escalated quietly by June 30th, the war sent crude prices surging from $60 to over $100 per barrel within months. This spike reignited deep-seated inflation fears, threatening to derail economic recovery entirely. Investors panicked because higher energy costs translate directly into more expensive goods at your local store next week, squeezing consumer spending power and forcing businesses to raise prices across every sector from food to transportation. The Federal Reserve responded with immediate caution, pausing its planned rate cuts and even entertaining discussions about raising rates again under new chair Kevin Warsh, who advocates for higher interest rates to combat this renewed price pressure. This rate change marked a stark departure from the previous years in favor of lower rate stance, creating unpredictable price swings that rattled portfolios worldwide. However, history offers context. Similar oil shocks in 1973 and 2008 triggered stagflationary spirals where growth stalled, while prices soared, but modern central bank communication tools have changed the outcome. Once the war concluded with a memorandum of understanding between Washington and Tehran, tensions dissipated rapidly. Oil prices tumbled back down almost as quickly as they rose, instantly freeing up cash for stocks, because inflation fears cooled just enough for investors to feel comfortable again. The dollar strengthened during the fighting due to a safe place to store wealth demand, but weakened slightly as rates stabilized and growth prospects improved. This single event rewired everything in 6 months, shifting market focus from fear of war-induced recession back to a renewed belief that profits can be made even with elevated energy costs, provided global political stability returns quickly enough for earnings reports to reflect reality rather than hypothetical disasters. Which leads to the gold paradox explained. The stock market split into two groups, the haves and the have-nots. The winners were anything tied to building artificial intelligence data centers. Memory chips saw demand outstrip supply so badly that prices rose by triple digits this year alone. SanDisk topped the entire S&P 500 with a stunning gain in just 1 quarter, because flash memory needs are exploding for AI servers. Micron soared nearly 90% in May, while Dell roughly doubled its value as companies bought record numbers of new computers to run these models. Nvidia became the most valuable company on Earth, topping $5 trillion at market cap by June 30th. It is easy to forget that this happened, even though interest rates were higher than many expected back in January. But look who got crushed early in the year. Software companies caught up in what Wall Street called the SaaS-spocalypse. Trade Desk, Workday, Adobe, and Salesforce all fell 30 to 40% because investors feared AI agents would eat their business models whole. Here's crypto had its worst half. Precious metals delivered the most volatile narrative of 2026, setting a tone that will define investor strategy for years. Gold surged into the new year with ferocity, rocketing toward an all-time high near $5,600 in January before succumbing to a brutal 4-month correction. The mechanics behind this divergence are rooted entirely in global political stability rather than pure central bank policy. For gold and silver to sustain rallies, markets require a durable ceasefire that allows oil prices to collapse. Active conflict nearby acts as an immediate headwind by driving energy costs higher. When fighting intensifies, inflation spikes because the cost of transporting goods and generating power rises sharply. This forces central banks globally to maintain interest rates at restrictive levels longer than anticipated to combat sticky price pressures. Consequently, non-yielding assets like gold become unattractive compared to bonds offering real returns in a high-rate environment. Silver suffered an even more punishing blow during this period, shedding approximately 18% over 6 months and retreating back toward the $60 per ounce mark as available cash in the market tightened. Crucially, central banks reversed their massive accumulation strategies mid-year. Having bought billions of ounces to diversify reserves against currency debasement fears earlier in 2024, they stepped away entirely once inflation expectations normalized and war risks receded into a distant haze. This shift mirrors the late 1970s transition, where gold's dominance waned as fiat currencies stabilized under tighter monetary discipline. For investors today, this implies that precious metals are no longer safe havens during wartime, but rather defensive hedges against peacetime inflation or currency devaluation only, when global political tensions subside sufficiently to lower energy costs and allow rate cuts. On to second half outlook. If metals faced turbulence this year, cryptocurrency endured an absolute catastrophe defined by relentless selling pressure and structural weakness. Bitcoin hemorrhaged capital almost every single month, down 10% in January alone, 15% in February, and another 18% or so in June, which capped the worst monthly decline of the entire post-2015 cycle. This wasn't merely unpredictable price swings. It was a fundamental rejection thesis as macro challenges crushed speculative demand, while institutional outflows accelerated. Net-net, Bitcoin lost roughly a third of its value in the first half alone, sliding from around $86,000 to $59,000. Ethereum did even worse, losing close to half its value over 6 months as investors pulled money out of exchange-traded funds at record speeds, signaling a decisive shift away from digital assets toward tangible store-of-value instruments like gold and silver. Historically, such synchronized declines across major altcoins usually precede a regime change or a prolonged bear market correction rather than a quick bounce. The mechanism here was clear. As interest rates remained sticky, the opportunity cost of holding non-yielding crypto skyrocketed, forcing liquidation cascades that wiped out retail borrowed money and eroded miner profitability simultaneously. For investors, this implies a harsh reality check. Capital is no longer flowing into digital tokens indiscriminately, but demanding superior risk-adjusted returns or regulatory clarity before re-entering at meaningful levels. The damage extends beyond price charts to the very viability of crypto-native projects that rely on speculative inflows rather than utility-driven adoption. Finally, let's turn to second-half outlook. The market's second-half trajectory hinges on a delicate balance. Can consumer price pressures ease, while crude oil remains subdued? If deflationary momentum materializes, battered assets like precious metals and digital currencies could finally secure their redemption arc by year-end. This mirrors historical late-cycle recoveries, where falling energy costs reignite risk appetite across non-tech sectors. Conversely, if inflation proves sticky or rebounds unexpectedly, stocks face a precarious existence dependent entirely on semiconductor giants to carry the entire index alone. Relying on just 5 or 6 megacap names creates significant fragility. Any stumble in that narrow band triggers broad, unpredictable price swings rather than isolated corrections. The critical rate change arrives later this week with the upcoming jobs report, which will offer vital data on wage growth and labor demand. Investors must simultaneously monitor Federal Reserve Chairman Jerome Powell's successor, Kevin Warsh, for subtle shifts in rhetoric regarding interest rate policy. A sudden in favor of higher rates turn from Washington could instantly lift chip how expensive assets look relative to earnings by reinforcing yield-hunting narratives, while crushing gold prices as the a safe place to store wealth bid evaporates under renewed inflation fears. This dynamic underscores a second-order effect, where monetary raising interest rates directly suppresses asset classes uncorrelated with technology earnings, forcing capital to rotate aggressively into AI-driven growth stocks regardless of actual profitability metrics. Consequently, portfolio managers must prepare for heightened unpredictable price swings and consider hedging strategies that account for the binary nature of this upcoming data release, as the difference between a gradual economic slowdown without recession and hard recession will dictate whether gold rallies or chips lead in the coming months. The first half of 2026 was a wild ride defined by global politics and technology. The war with Iran initially spiked oil prices, which hurt stocks but eventually ended in June to fuel the biggest rally since the pandemic rebound. Chips won because AI demand outstripped supply, while software names suffered from disruption fears. Gold hit an all-time high early on, then fell as inflation fears eased. Bitcoin lost a third of its value amid heavy ETF outflows. Thanks for watching Market Pulse Daily.